structure. After a downward movement, this happen, or this happen after a consolidation, after stuff like this, after a little bit of sideways movement, and you start seeing these three candles. Any pullback that you get from this, you should buy it, or any stuff that you get from like reaction after a little bit pullback, you want to aim it, you want to get into that trade, waiting for a potential reversal. Please, Cedric, mute yourself. Cedric, mute yourself, please. So yes, let's go to our continuation patterns. So all right, this pattern happens. This bullish continuation pattern happens when there is already an established uptrend. So unlike this reversal patterns that happen when towards the bottom or during a reversal, these ones happen when there's already an uptrend, meaning that there's already a trend that is going to the upside, and before you find these ones. When we actually start talking about structure, you see that this is something that you call a descending wedge, descending triangle. It will just look like something like this, but these are candlesticks. So let's talk about candlestick. Let's talk about bullish mat hold. So this is a 5 candlestick pattern. This is a bullish 5 candlestick pattern that happened in an established uptrend or in an established upward movement. So this candlestick is made up of 2 bullish candle and 3. Oh no, this candlestick is made up of 2 bullish candlesticks, and the three middle ones doesn't really have to be bullish or bearish. Like you can see one of them being red and another one being green and another one being red. It doesn't really matter what happened within the third one. These 3 ones don't really matter the type of candlestick, but this is a 5 candlestick. This is a bullish 5 candlestick patterns that consists of the first one being a strong bullish candle made up of 3 middle candles that open and close within the first candle. So in some cases, this one can open a little bit, like there could be a gap up here. There could be a small gap, like something we call a semi gap, like this close here, and then this next candle open a little bit up here, but it closed within the body of this. And then this one could be green, come a little bit up here. It doesn't really matter, but so long as it doesn't close below this, and your next candle actually is the confirmation, which is the feed candle. So this happens when this feed candle opens within the low and the body of the first candle, but it closes above, at least above the height of this. Remember, I told you guys this one sometimes can happen a little bit up here. So a bullish manhole candle stick pattern is a 5 candlestick pattern. It's a 5 candlestick pattern that happened during an uptrend, and it is made up of 5 candlesticks, and the second to the 4th candlesticks are usually the middle one that happen, that open and close within the body of the first candlestick, and the last one, which is the fifth one, closes above the height of the second candle. So this one, you will see this one during an uptrend. You will see this one like this is already an established uptrend, meaning that the price has been moving significantly strong, and you see this one strong, really bullish candle, and you start seeing a small pullbacks with these middle ones, and then you see a good confirmation with this. Sometimes you get a little bit confusion between this one and this one, but I'll tell you a different after I give you guys a characteristic of this. But yes, most of the time you hardly see this one. Most of the time, frequently you will see this one more than this one. But yes, sometimes this candlestick, this one open a little bit up here, like there's a gap a little bit up here after this closure, and there's a little bit gap for this opening, but it ended up closing below where it opened up. So ended up closing below where it opened up. That's how you identify this. So the second candle must be red. That opened a little bit up, but it closed below the height of the first candle. And again, like I said, the second one or the third one doesn't really matter the color, but the fifth one, the third one and the fourth one doesn't really matter the color, but the fifth one must be bullish, must be green, that close at least above the height of the second candle. And yes, you don't really have to trade this one by themselves as well. But if you want to trade this one by themselves, there is your entry, or you wait for something a little bit the low of that next candle and you get into it, you stop below there. Following the trend that already exists, probably use some tools to find where your target is. But again, like I said, use some other stuff before trading them. And you also have this rising tree method, which is a bullish candlestick pattern, which is made up of 5 candlesticks as well, but 2 strong bullish candlestick pattern, which is the first and the last one, and 3 intermediate pullbacks, and 3 intermediate candles which are bearish pullbacks, which happen during an uptrend. So when does this happen? Where there's already an established uptrend. This happens where there's already an established uptrend, and you get your 3 candlestick, the second to the fourth one, which open again and close between the high and the low of the first candle. It open and close between the low and the high of this. So this one must be red. It must open both here and close here. And this one also must be red. It must open within the body of this, close below. And this one also must be red. It must open below on the body of this and close below that. So yes, these 3 ones must be red, and the last candle, which is the 5th candle, has to close above the first one. So ideally, like I was telling you guys, it wouldn't look exactly as probably you might see on some charts. But yes, this is a crypto representation chart. So this has to close, or the high of this need to be above this first candle's high for you to confirm these patterns. And again, remember I told you guys these 3 must be red. Why these 3 doesn't necessarily need to be red, but the first one has to be red. And yes, and the other difference is this has to have a closure or a higher high above the first candle, and this actually needs to have a closure above the second candle, which technically this second candle height is supposed to be above this one. So technically this need to close above this as well, but most of the time you need to make sure that this close above this. So depends where this happen at. If this happen above here, this need to close above this, but this one need to make a high above this but close above this candlestick. I don't really know why this one is. I'm just explaining to you guys the way it's looking on this chart, but this need to close above this first candlestick. All right, and both of them happen in an established uptrend. And again, if you want to trade them, again, there's another difference. This one can open and close between the high and the low of this. So it means that you can have a wick down here, but let it close below, let it close above the low of this. But on the other hand, you won't really see this coming towards the bottom of this. It has to open and close within the height and the body of this first candlestick. These 3 ones open and close within the body of this, and this open and close within a high and the low of this candlestick pattern. So yes, there are both 5 candlestick representations, but they both happen in an uptrend. They both represent that price will continue going up, but just a little bit slightly different because yeah, this one require a gap that this candlestick should open a little bit above here. This one doesn't require a gap. This one does not require a gap. This one can open exactly where this one closes at, and it doesn't need to be above this, but this one definitely require a gap. And again, this one doesn't need to go below the body of this, but this one can open and close within the high and the low of this first candle. But make sure that the feed candles are always green and they have a strong bullish signal. And yes, you can trade this again using some other tools. Just again, after the feed candle, that is the confirmation, you open or wait a little bit for a small pullback. You open that next candle, your entry right there, stop below the low of that first candle and target way higher. Those are continuation pattern. Again, when you start trading structures, you will see something like this, like a bull flag. That is called like a bull flag, where you see so many candles happening there. You use like parallel lines or some triangles there. Once you break out, you enter on a retest and stop below there and shoot for the high. So these are just single candlestick. These are just candlestick pattern representing some structures. And we also have our bullish 3-line strikes, which also happen in an established uptrend. This happen in an established uptrend. So for this to happen, there has to be some type of trend that has already been existing, and then you have your straight 3 green candle, like I was explaining, just like 3 white soldiers, 3 strong closure green candles that the opening of the next candle happen within the body of the previous one and closes above the height of that, significantly above the height of the previous candles. And you have your 4th candlestick, which engulf the 3 candlestick pattern, meaning the body of this one red candlestick engulf the or the movement of all these 3 candlestick pattern. So you see that this ones has been good candles up to 3, but this one red one closes consume the body of all these 3 candles, signifying a bigger pullback. But this is a continuation. It's just indicating that it's a continuation in an uptrend, but this is a pullback where you need to buy. So again, ideally, you can trade this right here for a good entry, or you wait for the price to get back above here and you trade this for continuation and stop below there. You trade this for continuation, stop below there. But again, use other factors as well to identify your trades. But yes, when you're using structures, you also see a lot of different stuff that look like this. But when you see this one, it will look so scary. When there's an uptrend, when you see this, you think that, okay, this could be just an engulfing candle, right? A bearish engulfing candle by itself. But it's not, because there's been 3 consecutive candles in an uptrend, right? In an uptrend, in an existing trend. So you have to wait until price get here and you enter, stop below there, and target way higher. But in a case where you just enter the price here and not waiting for the price to get above here, this can end up acting as a bearish engulfing candle, which happen at the top, signifying a reversal. So this candle, normally the next candle should be green, or the next candle should start moving up. If the next candle doesn't engulf this whole body, at least 3 or 4 candles should get above here to signify that there's a continuation in that trend. Now this becomes your invalidation, and this also could act as an order block, which will now send prices way higher for you that you've entered here. So invalidation should always be up there, because this is trickier, could just be an engulfing bearish candle, but just because it opens below the height of this, you cannot really you cannot really identify this as a good engulfing candle, because a good engulfing candle, the one that engulfed the previous one, need to, at least be below or above the high or a low, depending whether it's a bearish or a bullish engulfing candle. So in this case, we say this should just work perfectly as a bullish three line strikes, that this one whole candle engulfed the body of these previous ones. So yes, you see that in an uptrend, and you can take that and trade that in your advantage after price and other stuff get above here, and other factors get above here. So before we explain anything for the bearish one, which is totally just the reversal of what we just did here, so it's just a total reversal of what just did here. If you don't want to actually put advanced block, you can say 3 stars in the north, right? Just like this, just like this. So technically, you all this is just the opposite of this, but we'll still explain it detailedly. So just for now, if you have any question that you want us to address, raise your hand and let's get that situated before continuing for other explanation. And please, I will say this again. Some people probably just join late, and they have a little bit of noise. They have a little bit of background. Whenever you join a meeting, please always mute your mics. Always mute your mics, because you're distracting some other people. So yes, if you guys have some questions, raise your hands up with the emoji, and let's deal with the question before we head next, so that we can head to the chart and actually identify all the stuff that we have said on the chart, on the re-chart, so that it make more sense, because that is what you're going to be trading on some pictures. Excuse me. Yes, Clovis, your hand is up. Unmute yourself and ask your question.
Yeah, I just want a small recap on what a hammer is, and also propose like if the candlestick pattern for the bearish movement is just the opposite of this like bullish one. If like considering like everyone was listening and taking down notes or can remember, it's just not necessary to do the one for the bearish one and instead go to the next thing, right? I don't know.
Yes.
Yeah. So please, can you like recapitulate a little bit on what a hammer was? I
Okay.
missed that.
Okay.
Uh,
Yes, let's get back on that. And so from the last class, we gave you guys what definition of what a hammer was, an inverted hammer was. So I'll just run over it again, just so you guys know. A hammer is just a single candlestick pattern. A hammer is a bullish reversal candlestick pattern that happens at the bottom of a trend, and the body and the tail or the low of a hammer is usually twice the size of the body. So a hammer is just a single candlestick pattern that happen at the bottom of a trend, and the body is often smaller, and the wick or the low is always at least twice the size of the body. So a hammer is just a single candlestick pattern that happen towards the bottom of a downtrend, signifying a potential reversal to the upside. So it's a bullish reversal candlestick pattern that you cannot use it on its own, but it's very strong. When you see it after a lot of sell off, it often signifies that there's going to be a potential reversal in price. There's going to be a potential reversal to the upside. So this usually happens towards the end of a downtrend, maybe in a consolidation after a downtrend, or the exact bottom of a downtrend. You will hardly see those ones right there at the bottom of a downtrend. And the inverted hammer is also a potential reversal. Inverted hammer is also a potential bullish reversal candlestick. It's also a potential reversal candlestick pattern that happen towards the bottom of a downtrend. An inverted hammer happen towards the bottom of a downtrend or at the bottom of a downtrend, and it signify a potential reversal in the market. Just like all these other reversal candles, it signify a potential reversal in the market. So if there has been a lot of selling pressure, a lot of selling candlesticks, and you start seeing something like this towards the bottom, towards cooling off, something like this, inverted hammer or a hammer, is signifying that, okay, this is a potential bottom. Or you start seeing something happening like a doji, and you start seeing a little bit of a consolidation, and you start seeing this popping out towards the downtrend or at the bottom of a downtrend, this is signifying that, okay, maybe we are about to have a new trend to an opposite direction where the previous trend was. On the other hand, a hanging man and a shooting star is just the opposite of this.